The broadcast is now starting. All attendees are in listen-only mode.
Here we are. Good evening, ladies and gentlemen. Thank you for being with us today. How's the volume, folks? Can you hear me all right, Norbert? Let's see who's on the ball here. Nobody, eh? Okay. Yes, okay. Came through slowly. Hank, you're usually the first down in Hunter Valley. Good to have you with us, my friend. And welcome, everybody. Well, I guess there's a whole lot of people who are actually watching the presidential debate today in the States rather than coming to share this tutorial with us. We've still got a very good crowd here. Lovely to have you with us. Let's see who we've got here. Here we are. We've got Milton. He's a grand stalwart, of course. We've got Anthony, we've got Andrew, and we've got Anthony from Sydney. That email of yours, Anthony, I'll send you a reply, but the answer is just that you've suggested don't use brokers who are using a spread. Always go for the fixed commission. The spread is just another opportunity for the platforms to steal a bit more as if they don't have enough. Toddy, great to have you with us, mate, down in Southern California. Terrific. And George, yes, the screen is being shared, and you should be able to see it. No, it's not. What is happening here? Goodness me. Let's have a look. Stand by for a moment, folks, while I try to work this out. Okay, lots of bugs and gremlins. Okay, George, thank you for that reminder. Screen wasn't showing properly. And Katarina down in Sydney, great to have you with us, sweetheart. That's my daughter who's gone on from her psychology degrees to she's now studying medicine at Notre Dame University in Sydney, which means that we don't get to see her because the state of Queensland is in lockdown. And we miss her dreadfully. But anyway, our local premier is keeping us all safe from the COVID virus as much as they possibly can, which in Queensland, I have to say, they've done a marvellous job. But your take on it depends whether you're in Brisbane and want everything open and to hell with the consequences, or whether you're more happy to be protected by your state government. We have Australia's a republic. We have states much the same as the states, and the premiers are in charge of the opening and closing the borders. But we want them to get on and open that Queensland border because we want our baby back for Christmas. So anyway, let's hope. And Greg, great to have you with us from Clearwater on the Florida Gold Coast. Sounds true. Oh, you're on vacation. Good on you, mate. Greg, nice to have you with us. And Sim is with us, and that means Peck Sim, the lovely Peck Sim, is probably with us as well. Great to have you. That's marvellous. Okay. So we should be able to proceed now after my fumbling start, for which I apologise. Okay, let's see what we've got here. Okay, well, you know this, folks. Market screen, the screen changing all right, so that's fine. Markets are rational, orderly. and sometimes predictable. We're going to have a look at some of that stuff in the meantime. This is from Frank DB. This is the fourth seal, which is our sort of it's our macro view of markets and our general forecasting to markets. Now, the fourth seal runs off longer time frames. So it uses a 6-day chart, a 12-day chart, and a 24-day chart, and you can go and peck Slim. She can't wake up. Well, she's pretty enough that it doesn't matter, Slim, I'm sure. The charts are available under the fourth seal. If you haven't already tried the fourth seal, I suggest you do look at it. It's a great place to start your week and sets the basis for the probabilities of the week coming up. So this is the S&P. Frank's saying we're mainly interested in sell signals here. If you look at the fourth seal charts, they'll show you where those major cycles are. This is gold. It's still consolidating. Fourth seal thinks that gold remains in this sideways to up channel into early November, and we remain bullish on that. Note that on all these fourth seal, it always finishes up the DC signals will guide us. You can't actually trade the fourth seal chart there because the risk on a 6-day chart, each single bar is made up of 6 trading days, ditto the 12 and the 24-day chart, and the risk is far too big, which is what we're talking about today. So you always need the Danielcode signals to pull you into the trade, or to elect the trade, as we say. Okay, so here's I'm sharing with you some stuff I've got from some of my clients this week, it's interesting. It's not what you expect. The first one, it's kind of interesting. That's from Dean, who's a very interesting character. Dean actually came to a Danielcode tutorial a long time ago, and I'm going to say 1980. Nothing like that. I'm going to say 2008 to 2009. And if I remember properly, Dean, that was in Colorado Springs. But anyway, then after that, that was a live tutorial we held there. After that, Dean came back to us a little time ago and did the new Danielcode tutorial with a particular emphasis on trading time signals. He's a very, very good trader. He's doing extremely well. You can see that he doubled his account for August, and he's at somewhere around 70%, if I recall, 68% for September. So that just shows you the probabilities and what can be achieved. I want you to particularly note in the second line, he says he's got a note on his screen that says, "I am not God." And I'm going to talk to you more about that as a very important part of trading, to know that you're not God. The next paragraph I'm sharing with you is from a wonderful gentleman. His name's Gig. He lives in North Carolina and Myrtle Beach. He's a serious professional trader. He's very, very keen. He's been trading for 30 years. And he's aware of everything. He's onto all sorts of trading websites, and any of the methods of trading you can think of, he knows about. So it's really very worthwhile to have him say that is the best education he's ever had in 30 years. So I very much appreciate that, Gig, and thank you for that, my friend. I hope you're well. And the final one's just a little note from Mark L, who's going to be a very, very good trader if he can ever get free to trade. He's also a very, very good factory manager, and he keeps getting offered factories to manage. And he tried to retire several times, and he keeps getting these very, very worthwhile offers. And of course, Mark, one of the beautiful things about trading, once you've done a Danielcode tutorial and know how to trade, is that the markets are always there for you. You can just go to them whenever you want to. But he makes the point there, almost 4 years since my tutorial, and you are still there for me, just like you said. One of the points about the Danielcode tutorials is we don't just say, well, there's your number of tutorials, we'll give you those, and good luck. The commitment I have to anyone who does a Danielcode tutorial is that I am here for you as long as the good Lord allows me to remain on this earth. And yes, I have clients who did tutorials 8, 9, 10, 11. In fact, the chap that was the second person I ever taught the Danielcode to is still a wonderful member with us. Of course, he's a pretty good trader, and but now and again he'll shoot me a line saying, saw something I hadn't seen before, or maybe didn't execute properly. Will you let me know? So that's how we treat our clients. So very important word for traders, because so much of trading is what's in your head, and many of my clients, tutorial clients, and I suspect people who are just using the Danielcode programs have this same program. And what I do is I say to those people, go away and get yourself a really large piece of sticking plaster, and then write on it backwards DOGTONMAI in large letters and stick it on your forehead, because that means that every time you look in the mirror will reverse the letters and it will say to you, I am not God. And this goes to this issue that the biggest problem that folks have is that they have a belief about what the markets are likely to do tomorrow. Now, trading futures is very different to trading stocks. Stocks, you buy your stock and whatever you want to buy, and that's your investment in it. And basically, there are sophisticated strategies, but for the average investor, they buy their stock and they hope it goes up, and if it goes down, they hope it doesn't go too far. And some of them are seriously brave. We had a Danielcode member who was a portfolio manager for Wells Fargo down in New Orleans. Mo, I don't think he's with us anymore, but Mo was telling his clients all the way down from the 2009 high to the 2007 high to the March 2009 low. Don't sell, don't sell. This is, of course, the standard refrain from brokers, and the don't sell means the market, you're banking on the market recovering, which it will one day, but when? He was lucky enough that he kept his clients breathing until they got to the 2007 low, which we forecast. Some of you will remember. But oh boy, buy and hold is it's a fantasy. Yes, it may be the market will recover, but what if you need the money in the meantime? So there's all sorts of things to talk about with that. Anyway, that's why Dean mentioned Dog Ton Mai, I am God backwards. Try and get out of his head that you have an opinion or think you know what the markets are going to do. Nobody knows. We only see the river of life backwards, and it ends in the current moment. And we know what's happened for the most part during our life, depending on how wild or lubricated your youth was. But basically, we know pretty much what's happened during our life, and we can see that. But we can't see anything forward. We do not know what the markets are going to do tomorrow. And anyone who ever tells you they think they know what the market's going to do tomorrow, run as far and as fast as you can. Only God knows what's going to happen with the markets tomorrow, because only God sees the river of life forwards and backwards. We don't see that. The whole point of trading Danielcode is the last completed bar on the chart tells you, if you know how to trade Danielcode, that is, I should say. The last completed bar on the chart tells you everything you need to know about which orders you need to place for tomorrow to optimize your chances of success. And that's what the Danielcode's about. And it's almost always in the market program. We've never advertised in the 12 years since the website was released to the public. We prefer you make that decision for yourself. We are more than happy if you have a free trial and see what we offer. There's very substantial testimonials from people who've done the Danielcode tutorial, and people telling you about their experience. That's the best test. I can say anything I like about the program, but when you have people that are giving you their observation on it, and they're also positive, that's the best endorsement you can probably ever have. So we're certainly very proud of the Danielcode. To the best of my knowledge, it's the best trading system that I've ever seen. There may be others, but I've been doing this for a long time, and nobody's ever pointed me at a trading program that consistently makes the returns that the Danielcode does. Okay, so let's move on to the real story of trading. Profitable trading is not what you think. It's not about getting the big runs. It's not getting into the big hit move. It's that's gambling. The profitable trading comes first of all from having a winning strategy and then executing it to perfection, subject to the vagaries of the market. So as close to perfect as you can make it. But the progression of your trades is everything. The Danielcode is a program that's in the market almost all the time. I'm talking about Danielcode tutorial trading now. It's in the market practically all the time, and the progression is everything, because the DC trading program has a relatively modest win percent, 55 to 65%. That's pretty much an average of all the markets across the board. But its average winning trade is 2 to 3 times the average losing trade. And some of you will understand mathematical progressions, and of course what happens with the Danielcode is it becomes a geometric progression, because with your risk model, as your profits build up the size of your account, then you can increase your number of contracts that you're taking. So this is not a double after a winning trade or anything like that. It simply says that don't increase the number of contracts you're trading until your account tells you to do it, because if you're doing it right, you will be making very, very substantial profits. So think about that. Some people, I know, I was talking to Dan earlier this week, who's an old tutorial client who's come back to do another time tutorial. He's a bit of a whiz at mathematics. He's got an engineering background and a Navy chap as a vet as well. But he said, if you can have a 1.5% win to loss, then you finish up with all the money in the world, theoretically. I know that's the big point about it. So if you think about it, if you have a 50% win rate, then you need the average win to equal the average loss to break even, and anything better than that, you make some money. But the Danielcode, the average win is consistently 2 to 3 times the average loss if you're doing it properly, and that makes you serious money. Okay, so the DC tutorial will teach you how to trade both time and price. You don't have to do the Danielcode tutorial. That's only one of the many features that we offer. You can simply subscribe to any of our programs, the TO3, the TO3 Plus, or 6S, and just trade the signals as they come. If you want to be really good at this stuff, you have to do a Danielcode tutorial. The main thing about it teaches you to trade both time and price Now think about that. When it's trading time, and you've learned how to trade time, you are creating entry signals and directional signals completely independent of market price. It's quite staggering. And since I've released the Danielcode time trading for the tutorials, we have a nice number of people who are doing very, very well indeed. So all of our Danielcode tutorial students are asked to paper trade natural gas for the whole of the 2016 year using only the Danielcode time signals. Paper trading does not account for slippage or commission, but that program for the whole of 2016 calendar year makes around 32,000 profit for the year. Natural gas futures right now are around 3,400. It was considerably less than that in 2016. So you can work out for yourself what the possibilities are with this program. Now, that was a good year. It's not a year that I handpicked. It was chosen by Mark, who I've been talking to you about, one of my students. And since then, I've asked all of our Danielcode tutorial people to do paper trade the whole year. And the first 4 months of it were not good at all, in fact. But it does show you what the possibilities of the Danielcode trading program are. So the greatest gift of futures and spot forex, which we trade as well, is leverage. And if you think about it, we're really being supported in trading our futures by the various exchanges. Now, I know that sounds a strange thing because I always tell my clients that the exchanges make rules for the benefit of their members, and that's not us. We're just part of the clientele. But the whole point of futures and spot forex from a trading perspective is leverage, and that leverage has to be there. Otherwise, people wouldn't trade it. And the exchange has various ways of doing that. I remember when I started trading, the US dollar index had 2 decimal points. It now has 3. So by adjusting the number of ticks in a market, and if you go from a 2 decimal point to a 3 decimal point, and the 3rd decimal point happens to be 5, then effectively in that market you double the number of you double the value of the moves. The next greatest gift, so we've got the exchanges working for us, making sure there's enough volatility in these markets, or making sure that there really isn't that much volatility in markets generally, but it's magnified hugely by the tick values and the number of ticks in a point, which the exchanges can set. So it's the greatest gift. Greatest gift I could ever give you is teach you how to trade futures and forex properly, because it makes you independent for life. The next greatest gift is the stop loss. This limits your risk to whatever level you find acceptable. I used to spend much of my life with a large string of racehorses that I bred and trained a bit and raced, and so naturally I've done a whole lot of betting on racehorses. But there's no stop loss when you do that. But in futures and forex, there is a stop loss, and that stop loss will take you out of the trade if it's reached. In other words, your stop loss is the position where you'll be wrong, and that's when you want to get out. And this limits your risk to, and you can manipulate that to whatever level you find acceptable. Generally speaking, those stops should be meaningful. They should go where they mean something. This means stops and stop and reverse must be at failure points in whatever time frame you choose. So if you know a bit about trading, you'll see if you take a buy signal, you should be able to nominate exactly where the number is, that if the market passed that number on the downside, the buy trade would have failed. And if that happens, then of course you are long and wrong, and you want to be short. And That's the essence of stops. Now, there's 100,000 ways of having stops. Lots of people use really tight little stops. It just means you get stopped out more often. Your stops should follow a logical progression. So the best daily returns I have found, returns on capital, come from trading daily bars. So you can never talk about trend without nominating the time frame. And for people who are short-term traders, what I'm saying now is completely foreign to them. And I've done it myself. I spent years of my life trading 10-minute bars, 5-minute bars, 3-tick bars, as small as you could like. But what I've found over almost 30 years in the business is that trading daily bars gives you the best returns. So inside that sort of discussion, I'm going to show you a few of the most basic stops. One of the important things about stops, but you need to find the stops that suit you. Whatever you may learn the Danielcode, at some stage you have to make that your own. You have to make that your program. So let's have a look at this chart. Excuse me, a bit of hay fever. This is the S&P E-mini chart quite recently. And you can see that I've shown you two highs, a counter trend low and a significant low. All of those highs and that low, and both those highs and the low, you'll recall, came at Danielcode time cycles, which we forecast with either blue line cells or TO3 plus reversal cells. So in the most basic form of trading daily bars, if you're going to sell the high of a bar, your protective stop goes, if you can sell the low of a bar, I should say, your protective stop will go at the high of the bar. Now, I use a 2-tick buffer. In other words, if I'm going to sell the low, it's the true low minus 2 ticks, and my stop would go at the true high plus 2 ticks. That's just a foible of mine. The trade is actually theoretically elected if the market goes to the true low minus 1 tick, not 2. But I got so annoyed by the number of times that you'd get filled just with a 1-tick move, and then the market would turn around and go the other way. That 20 plus years ago, I introduced using a 2-tick buffer. If you're trading Forex, folks, remember, Forex markets actually work exactly the same as futures markets. The Forex guys like to try and make it appear to be a different market. So they talk about pips instead of ticks. But basically the Forex market, the spot Forex market, and the currency future markets, all of them, they work exactly the same way. The only difference is that if you're trading spot Forex, you don't have the benefit of all of your prices going through a central exchange as you would have with exchange-traded futures. In spot Forex, the significant price of the true highs and true lows, which are the most important support and resistance on daily bars, that comes from the banks providing, they call it the liquidity, really the bank's information on what they're making their buy and sell rate for the day at. So if you're using a US platform, you'll find that it's a group of 4 or 5 or perhaps even 6 of the big banks who are fulfilling that function. If you're trading a European platform, you'll see that it's supported and it's getting its data from a number of European banks. And there's no central exchange for Forex. So the true high and the true low, the most important points on any chart, can slip a little bit. So we have to use not a 2-tick buffer, but a 5-tick buffer. And the reason for that is you can never be exactly sure that the true highs and the true lows are the same true highs and true lows that everybody is seeing. But there's your basic use of stops. If you're buying a high, your stop loss is going to go below the true low, minus 2 ticks. I won't keep repeating that. You'll get the message. And that's a very, very basic way of handling stops. Point about it is these stops are quite large. You can see the first stop was $3,000 odd. The second stop loss buying the low was $3,500, and then the third one selling the high was around about $1,800, $2,000. So average true range is the basis of the progression. So if you're thinking about proper professional trading, it's not jump in, I'm going to get this move. It's continuously being in the market, or almost continuously at least. And in that case, your progression is based on the average true range. And you can see at the bottom of this chart, I've added the indicator from Trade Navigator that tells you what the average true range is. All programs have that in there somewhere, so it doesn't matter whether you are using Trade Navigator or not. Your program will have that. And you can vary the speed of it by nominating the time period that the average is created over. Here I've used a 29-day average. That's as fast as I ever go, because I don't want to be reacting too closely to the market. In other words, as sometimes with the volatility we've seen this year, certainly, and you're going to see a whole lot more for the rest of the year, the average true range expands very, very quickly. I mean, really quickly. And if you're adjusting on something like a 5-day or a 7-day average true range, you're going to be recalculating your risk all the time, and your risk is not going to be consistent. Now, we can't keep our risk consistent because of the fact that market volatility expands and contracts. But we want to, as far as is reasonable and possible, to keep our risk on each entry very much the same. So do calculate your average true range for a start. You can use a 29-day period to do it, or if you want something slower, you can use a 59, 89. I used for a long time 255-day average true range, because I wanted to get rid of a whole lot of the drama that goes on in markets. But you need to know that average true range, because that's the progression that you're based on all the time. And if you think of your trading results as a progression, a long, endless progression, then you don't want to be in a situation that you're risking the average true range or thereabouts, plus or minus, generally, but all of a sudden you're going to be using 2 or 3 or 4 or 5 or 6 or 7 times average true range, because if that one happens to be the losing trade, you wipe out the 5 or 6 other trades that were giving you the profits in the progression. So very, very important that you're aware of the average true range. Now, lots of these programs, including the Danielcode, where we give you entry signals and the initial stop loss, they will be, the stops are actually, as markets expand in volatile periods, that risk is too big. So we have a rule, update your average true range, not too often. I know people who like to do it every 7 days, every 5 days if you want to, but it's just swapping around your risk. It's not as consistent as we'd like it to be. And as I've said, we can't actually make that risk matching permanent because markets do expand, ranges expand and contract all the time. But we would never ever use more than 1.5 times average true range as our maximum stop. So many times you'll see when you create your order and your initial stop loss, whether you're creating that from your own charts or taking it from the Danielcode website, that dollar risk is much bigger than 1.5 times ATR. And we don't want that to happen. So if that risk exceeds 1.5 times your ATR, use a fixed dollar stop equal to 1.5 times ATR. For those of you who've done a Danielcode tutorial, you know how easy it is to get back in the market. You can get back in the market at any time. So being stopped out is not a big deal. But managing your risk through the progression is a very, very big deal, because that's the essence of successful trading. So when you have a look at any chart, this one is still the S&P, you can see that there's always going to be counter trends. Markets don't move in straight lines. They move a bit and they retrace a bit. They move a bit and they correct. They move a bit and they correct. And one of the most interesting features of those corrections is that in trending markets, corrections tend to fail. So ideally, we want to be aware of that, and if we're taking a trade that appears at the time the trade is placed to be a counter trend, we want to use a smaller risk than we would if we think the trade is with the apparent trend. Now, you'll hear me words like think and probably. When you look at market charts, what you're seeing, that's human emotion. That's a measure of emotion. When people are excited, think the market's going up, think it's going to go higher, they buy more than the selling pressure, and vice versa. But a trending market, pretty simple definition, is higher highs, higher lows gives you a trending market. That's oversimplifying it, because we need, for our trading at the Danielcode, we need to have a view about what the trend change is on a one-bar basis. In other words, the last bar should allow us to calculate or observe what is the apparent trend. Okay, so I say apparent because you can put that order on thinking it's a trade against the trend, and it finishes up when that bar has closed for the day. You'll say, the trend has probably changed. And whether you think you're in a trade against the trend or with the trend requires different stop loss management. If you think your trade's with the trend, you can be more generous in your stop loss. If you think the trade is against the trend and therefore it has a higher probability of failing, then you want a tighter type of stop loss. Okay, let's have a look what they are. So the really important point about stop losses is they should be at important failure points. In other words, they should mean something. That's the first and most important part of it. Every trade has its own stop loss order. There are no trade orders without a stop loss. That's absolutely vital. And never use more than 1.5 times average true range as your stop. And if your correct position from a charting point of view for entry and stops, which is what we give you on the Danielcode programs, if that's bigger than 1.5 times your average true range, use a dollar stop equal to 1.5 times your average true range. And you can adjust the average true range, as I said, by altering its speed. You can make it shorter to be more in tune with the market, or longer if you want to smooth out the market. So far we've been looking at 1-bar stops, and some of those stops actually finish up being 2-bar stops, and that's a very simple choice. But you can also use a fixed dollar stop, as I've been talking about, and you can also turn that fixed dollar stop into a trailing dollar stop. I'm sure you all know what trailing dollar stops are. If you are buying a market and you put on a trailing dollar stop, the stop loss moves up with the market, but it never comes back. So in other words, if the market goes up, it drags your dollar trailing stop up with it. If the market reverses, your dollar trailing stop stays in its last position. It doesn't come back. And often enough, when you take a trailing dollar stop on a trade that appears to be against the trend, you'll make some money on it, even though that trade fails subsequently. So being aware of that risk is vital. If you can't keep your risk within the parameters I'm suggesting, then your progressive program is being defeated by you. Or as I said a bit earlier, the biggest risk, in fact, is you and your brain. And excuse me, so often I hear people say, I can't put the stops on, I just can't, it's too much risk for me. Well, you have to make sure that before you decide to put an order on, you must know what your stop loss is, and you must have calculated that so you're comfortable with it, not only for your own mental health, and so you're going to be able to hold this stop. If you're happy to put the initial stop on, then you should be comfortable to hold that sort of risk right through the trade. And if we're with the trend, of course, we're going to try and hold that trade as long as we can, or until we get a reversal. So Greg, who is on holidays, as he told us, he's a Colorado Springs guy. Let me find his post here. Here we are. Here he is in the Florida Gulf Coast. Here he is on vacation. Greg and also the other Greg over in California. They're both wealth managers. They're trading money for people, and they're interested in a more gentle, more relaxed stop-loss program. This is one that I've shown you before. This is part of the basis of this whole business that I'm calling slow-mo, because to my way of thinking, this is trading in slow motion, which may be a very good thing. And you can see that this program does incredibly well using that sort of moving average situation you can see on the chart. The problem is that the moving averages are not equal. In other words, you have to have a view at all times of the dominant trend. Now, I defy anybody apart from Frank DB to say that the February pullback, the flash crash, the quickest bear market in history, 27, 28, 29 days, whatever it was, I defy anyone during that period to say the trend is still up. Frank did. Frank not only did, but he's written an article. It's at the website. Click on the articles tab, and it's simply called 2021, I think. He maintains that from the fourth seal analysis that he does for us, this market, the probabilities are that it remains up until the middle of next year, when we can expect some drama. Having said that, during that, what was a pretty panicky flash crash in late February, that you can see the big down leg there, he was adamant in the fourth seal, for those of you that follow it, saying, I know it sounds silly to say this, but the trend is still up and it's going to continue up. I mean, at this stage, it's the most brilliant market call that I can remember. It's quite fantastic. Anyway, so there's a problem with this particular model because it uses uneven parameters. This is the next development of it that I'm going to be introducing to you in the next week or so. Terry's away interstate, in fact, intercountry. He's down in Phoenix, Arizona, for another client at the moment. But I'm going to get a template up, and you're going to have access to it free for at least until after Christmas. You can have a really good look at it. And what that's going to do is it's going to use even moving averages, as this chart does entirely. This is the Aussie US dollar Forex pair. And it creates signals on the close only. So what's the criticism of it? The criticism of it is that it's slow. The run up from the big important low at the beginning of April, that just left a whole lot of money on the table. And you can see the risk as you go through this model. The risk is much bigger than anything I have become used to. And I'm not entirely sure yet that it's justified, but if you just look at this chart here, which uses even moving averages to create the signals, they're created only on the close of the bar. So it's a very relaxing way to trade, but you wait to the close, and you just have to look at the close to decide if there's a buy or a sell signal there. And if so, go to market. That's one option. A better option is to treat this signal as a trend indicator, and after you've got a buy signal, take the next buy, which might involve a retracement before you get long. And the same with the sell. When you get a sell signal, wait for the next valid sell signal. Doesn't always work. Sometimes this market will hit these numbers and keep going. But I think we can be a lot more sophisticated than that, because our Danielcode trading is so precise. I think that we can improve that a lot. But if you just look at this chart overall, it's had a couple of drawdowns, nothing too big really. It certainly got a nice earn out of the big run up. It then had a period where it was dramatically wrong for a number of days. It went short, and it didn't get long until 1, 2, 3, 4, 5, 7, might be 17, 18 bars later. But overall, this looks very, very promising. So that's the new program we're going to be releasing for you in the next. I was going to say we'd have it next week, but I'm not entirely sure we would. Moving on, this is always an alternate to your trading. You can use a longer time frame. What we've done here is we've just used the minimum expansionary time. We've gone to a two-day bar. So each completed bar on this chart has 2 trading days in it. And it magnifies the wins and it magnifies the losses. And the problem is, you can see what the drawdowns are here. Well, you can see what the wins and losses are. Looks pretty nice, but this is a highly, highly dynamic market. The question is, and I'm going to run this new stops only program across a range of markets, but this is a very dynamic market, and pretty much anything you do in it is going to make money, because apart from the one decent, really big pull down, the bias has been so positive for so long. This is sort of starting to look at its numbers at the beginning. It's very late October 2019. So essentially that's 2 years of charts. But there's a problem with using these longer time frames. And the problem is that by using those longer time frames, you're reducing the amount of funds you have available to invest. So I'll come to that in a moment. But if you look at this existing chart, we're still on the S&P here, you can see it just this very simple bar chart. There are 3 trend changes, and all of them have come within 1 bar of the turn, or 2 bars where we got an inside bar. Where you get an inside bar like the final turn down that we're in now, the inside bars for trading purposes are treated as a null or a void. In other words, you don't get anything from the inside bar. An inside bar, folks, if you don't know, and I'm sure all of you do, it's called an inside bar because it has a lower high and a higher low than the preceding bar. In other words, it's wholly enclosed inside the range of the previous bar. That's why it's called an inside bar. Those bars in red on this chart are inside bars. The bars in grey, they're outside bars. Same logic. They have a higher high and a lower low than the previous bar, and their range is outside the range of the previous bar. So you can see that normally here we've identified the 3 trend changes. 2 of them are reversal bars, and one is sort of a continuation of the inside bar. Inside bars, don't ignore them altogether, because when we come to forecasting future time and price, inside bars become very, very important. But for trading purposes, you treat them as a null or a void. So you can see here we've been able to, during the time with our signals, this is fairly recent. It's been wonderful trading, hasn't it? We have been able to identify a probable change of trend from one single bar. And that's what we've got to be able to do. It's vital that we can see a trend change with a high degree of confidence before anyone else can see it. As I said earlier today, you can never speak about trend unless you nominate time, because it's quite possible to have different trends in different time frames all happening simultaneously. That's why markets move up and down and don't go in a nice straight line. But we need to be able to see that probable trend change before anyone else does. So I was talking about bigger stops reducing returns. So I know quite a good program that the gentleman keeps sending me his data for some reason, but it's using a $25,000 stop for the S&P E-mini, which is pretty well almost twice the margin. Well, what that means, if you want to trade that sort of a program, you're halving the return on investment because you've only got half the money to invest. In other words, you'll be taking one contract, you're taking two contracts instead of taking one contract. I got it right the first time, folks. You'll be taking one contract instead of two. In other words, you're halving the return on investment. Now, what's the optimum progression? The optimum progression uses stops of the average true range or smaller. We do use 1.5 times average true range occasionally, but that's the limit. Now remember, trending markets do not generally correct more than 3 bars. That's old market law. It's not like all of the old market law. It's not exactly correct, because you'll see often enough markets will correct 4 bars while still in a trend. But they're the simple corrections that we can see. There's a whole host of other corrections that we don't see so clearly. But if you're going to increase your stops that much, you've cut down your available funds for investment. I maintain that the way you calculate your return should always be as a result, as a percentage based on margin, because margin is the indisputable minimum amount that you have to put up to trade that market. So it's appropriate to, I think, to define your return in terms of margin. But a lot of people don't like to do that, and they use it as return on the total capital available for investment. But if you're going to double your margin or make your stop equal to twice margin or more, you effectively halve the number of contracts you can take, and that diminishes your returns. Keep thinking, folks, about the Danielcode time turns. This is the same thing. This is the S&Ps I've been talking to you about over the, quite often, actually. And this is showing you these lunar cycles, which we had a special webinar on a few weeks ago. You can see the September high had at least three lunar cycles expiring at or about the high of that move. Now, remember, Danielcode time cycles are valid for plus or minus 1 period. The reason for that is that if you're talking about lunar cycles, and we do use other cycles as well, but particularly if you're talking about lunar cycles, if they fall on a Saturday, they'll be shown as falling on a Friday. If they fall on a Sunday, they'll be shown as falling on a Monday. So that variance is built into just the nature of our calendar. So these time signals, they're perfectly perfect because they're valid to plus or minus 1 period, and they're pretty fantastic. The low there came on 62 days from the perigee and 44 days from perigee, and a 50 period as well. This last high we've had 29 days from the full moon, 44 days from an apogee, 70 from a full moon. The last two numbers there you can see, they terminated on the day before the high. So that's why I say this stuff is valid for plus or minus 1 period. And that's just because of the nature of it. Interesting, isn't it, how the market just managed to turn itself around today with a nice key reversal bar. And Friday will be the expiration of a 59 cycle. And of course, in equities, Friday is hugely seasonally bullish for equity markets on Friday. That's the pretty usual pattern. Okay, folks, keep watching the Danielcode members charts. They're really quite extraordinary. This is happens to be T-bonds, and this chart was posted on Wednesday evening. And you can see at that stage the market had got down to the blue line low there. In fact, there's a blue line buy signal, TO3 and blue line buy signal for this market, valid for Thursday and Friday, and the blue line portion will endure until Monday for a turn. But look what this market done on Wednesday. The low was 172 carat 17. That little arrowhead is called a carat. The low was 172 carat 17. Have a look at the blue line, 172 carat 16. In other words, it stopped within one tick, which is not even a hair. We allow plus or minus 0.1% variance. So the variance there was one tick, like nothing. So what happened the next day? What happened today? Same thing, down this market went. It didn't hit the blue line at the low, but look what it did at the close. The close is 172 carat 1. There's a red line there, one of the swings, retracement 172 carat 1. In fact, the blue line is at 172 carat 3. So it still only has a 2-tick variance from the Danielcode blue line, and the other requirements for blue line trade, which are our stronger signals, they are in place. So keep an eye on these members charts. It's amazing. Nobody's more amazed by this stuff than I am, but markets are ruled by the Danielcode, and I don't say that in a boastful way. It's been my observations over the 26, 27, maybe 28 years since I started the search for the Danielcode. Okay, I think that's going to be us for the day, folks. If you want to be a super trader and join the elite, and you'd like to do all these things that I've shown you here, and the different methodologies of trading and risk management, let me know. Please just shoot me an email, jneedham@thedanielcode.com, jneedham@thedanielcode.com. Let me know you're interested in a Danielcode tutorial or any other facet of the Danielcode. And if you would like me to call you, let me know where you live so I don't call you in the middle of the night, and of course your phone number, and I'd be happy to talk to you about it. Okay, so Website Pro, for those of you folks, if you are subscribed to the Danielcode Website Pro, that's the $2.99 version. Remember, please, that you're entitled to 2 free 6S markets at no additional cost. Let Terry know which markets you're interested in, and he will get you switched on for that. That's just a little bonus. I want to reward the people who are subscribed either to the Website Pro or better still, the website, all of it, the $4.99 version. You really are the backbone of the Danielcode, but we have people who don't trade as much who take one of the smaller programs, and we are delighted to have them as well. Okay, so remember, folks, the business of trading futures and Forex, it may appear as if we're right all the time, and we're showing you constantly where we were right with the turn at the right number or the right time cycle. But the business of trading is not being right. The business of trading is making money, and that's seriously what we're about. If you haven't already had a free trial, folks, you're most welcome to do so. Just go to the Danielcode website, click on the free trial button. That should set you up. Any issues at all, contact Terry at support@the-Danielcode, and he will be more than happy to assist you. And that's about it for us at the moment, folks. You had a good turn up at the end of the day. Thank you very much for everybody turning up so much on a busy, busy day. So that's about us for the day, folks. Murph, fabulous to have you here with us, my friend. and Jeff as well. I haven't heard from you for a long time. Good to hear from you, and glad you enjoyed it. I'm off to go and watch the recording of the presidential debate, folks, and John L. He is the nicest bloke you've ever met in your life, John from Coffs Harbour. He can't get to see me, and I can't get to see him because the Queensland New South Wales border is shut. But here, Katerina, my darling daughter, enjoyed it as well, and I can't get to see her either because, like you, John, she's down in New South Wales. She's at Notre Dame Medical School in Sydney, having got first-class honours in psychology and done a PhD. Why is she now doing medicine? Well, she's an interesting young lady and very beautiful and sweet as well. Okay, so that's it, folks. Thank you for being with us. I really appreciate it. If you have any questions, I enjoy the mental breakdown. Says, yeah. Trump's doing much better today. Good for you. I'm going to watch him. See you soon, hopefully. Yeah, indeed, John. As soon as these borders are open, I'll be the first man through. Thank you for being with us, folks. Any questions, please shoot me an email, jneedham@thedanielcode.com, and I'll be sure to get something prepared to present to you at our next webinar. That's it for now. Enjoy your weekend, and I look forward to talking to you soon. Bye-bye.